biggest surprise has to be the US stock market. Exactly a year ago, consensus for the S&P 500 for the end of this year was 4,900. And here we're sitting almost at 6,100. And of course, everybody is, even the strategists and analysts are now momentum chasers, because now everybody is talking 6,500, 6,800, 7,000. There's not many years that you're off by 1,200 points on the S&P 500 on a consensus forecast. The big surprise was that on an 8% earnings growth profile, the stock market's up almost 30%. Almost 5 points of multiple expansion in a 12-month span qualifies as a 2 standard deviation event. Doesn't happen that often. But that was, to me, the big surprise for this year. I wrote a piece called Lament of a Bear, putting myself in the shoes of the bull. And what did the bulls and what did the overall market, what did they tell us? What did they get right over the course of the past year? And I had ascertained that leg of the bull market we're in right now really started. I mean, remember, we had a horrible year in 2022. And then in the spring of 2023, we get NVIDIA and the blowout numbers and the guidance. And I think we can date May of 2023 as the inflection point of this massive generative AI trade. Just as we could date the summer of 1995 when Netscape went public as the start of the internet mania. So this really started almost 2 years ago, and then it's cascaded into this year. And of course, it's broadened out. So what I had said was, under the proviso that we've hit an inflection point in the technology curve, that we've engaged in some sort of a model shift. And we've seen a shift in the technology curve with all sorts of future implications for productivity growth, and then what that means for corporate profits, since productivity leads to a lower corporate cost curve. And I was always wondering all year long, looking at all the classic different multiples that we look at, price to earnings and price to sales, price to book, the Buffett indicator, everything is just off the charts. And yet money is just plowing into the stock market like it's nobody's business at what I thought were these borderline insane, or maybe just insane valuations. Well, if in fact we're in this situation where investors are looking at what AI is going to deliver in the future, then the investor class has naturally lengthened their time horizons. So they're looking beyond just the next year. They're looking at the next 5 years. And we saw this last during the mid to late 1990s, how investors reacted to the onset, the advent, and proliferation of the internet and all its applications and all the assumptions that were made. So there's a lot of comparisons, similarities, there's differences, but a lot of similarities, because that's the last time we really had that sort of inflection point on the technology curve, and we know what happened. 1995, starts off as a internet bull market, turns into a raging bull market, then turns into a mania, then a bubble, and then the bubble bursts. And I suppose that, and not really a conclusion, but just an observation that it's next to impossible to know. I mean, we're not in 1995 or 96, but maybe we're not in 99 or 2000. Maybe we're in, 1997 or 98 or 99. Where are we in this phase of the symbiotic relationship between a new technological innovation and the market process of pricing in the future? So I was willing to entertain that. That is the primary explanation, is that investors have lengthened their time horizons and are willing to ignore the classic valuation metrics that in the old days, I think would have had anybody concerned, or certainly taking profits, rebalancing the portfolio, diversifying. None of that has happened. That's really what caught my eye this year, was that the market is moving north in a serious way, and there's been no rebalancing. Nobody's taken profits. Nobody is diversified. Everybody is all in. So a lot of this was trying to explain what is with this behavior. And I said, I don't think I'm going to call it a bubble anymore. I'll find something else to call it. Maybe it is just a mania. But I also said that maybe there is something beyond the mania that isn't completely irrational. It doesn't mean I agree with it, but in my piece, I tried to explain what it is that the bulls are seeing and what the bulls are pricing in that I didn't bother to do this past year. And that was the premise of the report. Even when we adjust for interest rates, the classic multiples are still historically at the high end of the range. Yeah, inflation came down, and you would say ordinarily that should be positive for multiples. I would tend to agree with that, but a 5 multiple expansion under any circumstance is absolutely extraordinary. And as I put myself in the feet of the bulls, I try to ascertain the market is pricing in a future. What is that future? Let's go beyond just 1 year expectations. And we went back into 100 years worth of data to do this, to figure out what is the 5-year annualized growth embedded in valuations today. What's the market expecting? What's the market telling you? And this is what my report was about. My report was not pushing my view. The report was trying to explain that the market is telling you that it expects earnings growth to average 20% annually per year for the next 5 years. That is about triple the historical norm. Now, it did happen, by the way, in that period of the mid to late 1990s. Although I would argue, maybe I would call generative AI, internet light. It's not the internet. The internet was like electricity. That was a fundamental game changer in every meaning of the word. Historically, getting 20% per year earnings growth over half a decade is a 1 in 20 event. It's happened 5% of the time. So I'm not going to say zero, but I'm going to say that's the bet that the market has laid down, that the productivity revolution is going to be so strong that profits are going to be triple the historical norm over the next half decade. If you believe that, then this market is for you. Something else that was a surprise to me was I did not anticipate that the equity risk premium would be wound down almost to zero, that the ERP, and no other country in the world has this dynamic except United States, American exceptionalism. ERP is basically zero. So I didn't anticipate that stock market investors would be treating the stock market as a riskless asset, because that's what happens when the ERP is zero. The earnings yield in the stock market is equivalent to the risk-free rate, call it treasury bill yields. So the market's telling you that the equity market has become a riskless asset class. The stock market is telling you that it will not go down. And I suppose with Donald Trump's electoral victory, that view's been even emboldened because there is this pervasive view that Donald Trump is bigger than human nature, bigger than the market cycle, and that the government will not let the stock market go down. And that's layered on top of the view that because of AI, the market is not going to go down. Now, if you have that belief that the market is not going to go down, you should be all in on the S&P 500. But you see, that is the message from the market. That's what I wrote about. I also had gold, and gold did just as well. And there were other markets around the world that I liked where actually the equity risk premium is positive, which means as an equity investor, you're getting paid to take on the equity risk. And, it's not just the stock market. Again, you asked me about the surprise. Did I think that by this time last year, did I forecast that things would get to such an extent that the yield on a Ginnie Mae mortgage bond with the implicit government guarantee at, call it roughly 5.5%, would be at the same yield as a BAA corporate? So the same thing is in the bond market. The bond market's telling you that a corporate bond with a 2% default risk is being priced the same way that a government guaranteed mortgage bond is being treated. So what I'm saying is that the concept of risk, that is really the big surprise, or the big theme of 2024, was how the concept of risk was so totally altered over the course of the past 12 months, where you can't differentiate between a guaranteed mortgage security and a corporate bond and the stock market and a treasury bill. That's something to think about going into next year. It's all part of the same speculative trade. Bitcoin at 100,000. Well, what did Bitcoin do to get to 100,000? It took Donald Trump to get elected. It was hovering around 70,000. It's all speculation. And it's all part of the same risk-on trade. Credit spreads, you see, once again, stock market is priced in a way that investors believe it will never go down. And credit investors now are basically priced for there to be zero defaults. We are priced for zero defaults. So in an equivalent way, that what you'd call like the equivalence of the ERP in the bond market, saying the same thing. We are entering into a world, no defaults, and entering in a world where the stock market will not go down. In fact, the market's telling you, when the ERP is zero, that for you to be fully invested in this market, you have to believe that there will never be any sellers. Everybody talks about the mountain of money on the sidelines. Well, maybe it's a hill now and not a mountain. When you look at the inflows of ETFs, I'm blown away. If you look at the chart of the inflows into equity index funds, passive index funds, that chart looks like Bitcoin. I'm astounded that we are now up to 60% of the market cap in passive index equity funds. I mean, when John Bogle first unveiled ETF in the mid-70s, he said this market will never get more than 20% of the total capitalization. We're getting towards 60%, and the inflows are incredible. Looks like a dot-com stock in 1999. And so this is all part of the momentum. And of course, it's all part of the self-reinforcing upward spiral because these index funds have to invest in the index. And for the general public investing, they don't even know what it is they're buying. They couldn't tell you one stock in their portfolio. And why bother when you think about it, investing with an active manager when 3/4 of them have underperformed the index and the index is so much cheaper? But then again, active investment management is not blind investing. You know, the portfolio managers or the CIOs, they're skilled, they have their CFAs. Nobody's perfect, but they do look at balance sheets, they do look at income statements, they do look at valuations. But when you're investing in ETF, there's none of that, and that is unremittent bull market. The bull market at ETF investing, and that money has to be put to work. I guess I didn't anticipate at this stage that when I look at the household financial asset mix, 70% is in equities. Only 12% is in bonds. And that's true. This is from the Fed flow of funds data. Of course, bonds are for losers. You're not going to talk about bonds at the cocktail party. Nobody want to have a conversation with you. And the rest, of course, is in cash. But we've never been at 70% before in terms of the concentration of equities on household balance sheets, not even during the internet era of the late 1990s. This is off the charts. And when you look at baby boomers, you know, the 80 million pig in a python, baby boomers like myself, we should be between 30 and 40% in terms of the life cycle in equities. They are over 60% in their asset mix. We've never seen this before. Everybody is all in at the same time in exactly the same trade. Portfolio managers themselves, looking at the ICI mutual fund data, and I didn't predict this, that we're down to just over 1% liquidity ratio, cash to asset ratio for domestic equity funds. In the overall annals of financial history, we've never come close to being that low. Imagine, God forbid, if we ever see any redemptions. But those are the surprises. The fact that we still have such huge inflows in equity ETFs with the valuations where they are, even if you're willing to take a long-term view of valuations, which is what I did. It might not be a bubble, but it's a mania. And I don't invest in either one of those. But that's really the story for the past year. I come back to the fact that the whole concept of risk has been turned upside down. And it started 2023. It's not just a 2024 story, but it's a story that is accelerating. It's a concern to me. Bob Farrell's 10 market rules to remember. Everybody should have those pasted onto their Bloomberg terminal or their computer. And rule number 4 is that exponentially rising markets go further than you think, but they don't correct by going sideways. So there's your story for 2024. Exponentially rising markets go further than you think. And this market went further than I thought, that's for sure. But because the consensus was 4,900 for the S&P a year ago, it's gone further than everybody thought. But it's the second part of rule number 4 that concerns me, which is that these do not correct by going sideways. And I don't know when the peak is going to be. I don't know what week, month, or even year. Okay, I remember Chuck Prince back in the summer of 2007 telling everybody, you got to keep dancing till the music stops. But I don't think he knew or anybody knew that the music was going to stop 4 months later. But there's a lot more at stake now because of the exposures and the concentration of risk on household balance sheets. That to me has to be most unnerved. What happens when everybody thinks they're going to try and time the peak? You see, the one thing that has not been repealed, and not even Donald Trump, is bigger than Mother Nature. There is the market cycle. And there's peaks and troughs and bull markets and bear markets. And I'm really concerned that when the peak comes and everybody thinks they can time it and they try and get out at the same time, there's not going to be any bid. There will not be any buyers on the other side because everybody except maybe me and Warren Buffett. And I guess, you put me and Warren Buffett in a room together, I guess if you took the average, I'd be a billionaire. But there will not be enough buyers on the other side. I'm really concerned about the next bear market whenever it comes because it's going to be very severe. I'm not talking about the great financial crisis. I'm not talking about bank failures, but I think it's going to be as bad as what we saw in 2000, 2001, 2002. And that was no picnic and no bank went down in that period. I don't know when it's going to start. I'm not going to lose any sleep over trying to even time it. I just know that when it happens, just as the buying through the ETF mechanisms was a self-reinforcing development, when the movie rewinds, it's going to look a lot different, but in perfect symmetry. And that's what has me concerned.